Welcome to this explainer. Today, we're diving deep into Roku. We're going to synthesize historical market seasonality with actual fundamental business health. Our goal? To give you, the long-term investor, a crystal clear picture of Roku's overall performance. So if you've ever found yourself wondering whether you should trust the calendar or the balance sheet, well, you're absolutely in the right place. Let's get right into it. But before we map out our full journey today, I have to share a crazy historical fact that completely changed how I view the fourth quarter for this stock. Get this. According to historical market data, the month of November has historically delivered a massive 22% average gain for Roku. I mean, wow, that is a staggering single-month average that really demands our attention. Here's our roadmap for today's explainer. We'll start with Roku's seasonal stock trends, then pinpoint the best and worst months. After that, we'll track the positive performance frequency, look beyond seasonality into fundamental health, and finally, wrap up with the long-term investor perspective. All right, part one. Let's dive right into Roku's seasonal stock trends and that historical calendar. Looking at the seasonal matrix data here, a super clear pattern jumps right out at us. Check out that really strong cluster of above-average returns right in the late spring and summer. We've got May at about 8%, June at 9.3%, and July peaking at over 10%. Not bad, right? But look at the top of that table. Late fall, specifically November, is literally in a league of its own with that massive 22% average historical gain we just talked about. Moving on to Section 2, the best and worst months. It's time to identify those extremes. When we put these extremes side by side, a pretty stark reality emerges. On one hand, you have November's massive 22% average gain, but on the exact opposite end, the steep historical slump of March, which historically drags the stock down by over 10%. Guys, that's a massive 32-point swing, just depending on what page of the calendar you're looking at. And let's be real, March is usually painful enough without taking a 10% hit to your portfolio, right? As you can see, November is the undisputed heavyweight champion here. It drastically outperforms the significant historical losses we typically see in March and September. For an investor, simply understanding this rhythm, this historical ebb and flow, is a totally crucial piece of market context to have before you make any moves. And just to highlight how wild these seasonal swings can actually be, we need to look at the absolute extremes in the data. Think about this. November of 2017 brought an absolutely incredible 115% gain in a single month. Yeah, 115%. Conversely, September of 2019 saw a brutal 32.7% drop. When Roku swings, it swings incredibly hard. That makes it absolutely vital to look at the underlying drivers. So you're probably asking, why November? Well, it actually connects directly to our real-world habits. Right in the middle of November, Roku aggressively pushes festive content hubs, like their season streamings collection. By putting easy holiday classics right on the home screen, they basically lock us in. I mean, considering our collective tendency to binge-watch Home Alone and Elf all weekend as soon as the weather turns cold, it makes total sense, right? More of our viewing hours equals way more ad impressions for them, translating directly to the bottom line right as the year closes out. That brings us to Section 3. Let's look at tracking positive performance frequency and consistency. Now, if we shift our focus from those big average gains to actual consistency, June reveals a really impressive win rate. Sure, November has the highest average gain, but June is actually the most reliable. Historically, it finishes positive a staggering 87.5% of the time. That means only 12.5% of the time does it close out the month in the red. Honestly, that is some remarkable historical reliability right there. And May follows really closely behind June in this consistency metric. It reliably turns in a positive performance nearly 78% of the time. So while the fall brings those massive, sometimes volatile gains, the late spring period of May and June has historically been a much steadier, more frequent period of positive returns for Roku stock. Okay, but before we get totally swept up in the calendar and start planning trades based on the month, we absolutely must remember a crucial warning. Past performance does not predict future results. Relying purely on seasonality carries significant risk. Think of seasonality as a map of where we've been, not a crystal ball showing where we're going. Which perfectly segues into Section 4, beyond seasonality and into fundamental business health. Because behind all those seasonal calendar dates is a rapidly growing, real-world business. Just take a look at this snippet from their Q3 shareholder letter. They delivered positive operating income ahead of schedule. And that highlighted box, that is incredible. Platform revenue surged 17% year over year to over $1 billion for the quarter. $1 billion. This really proves that Roku isn't just some seasonal trade, it's a massive, fundamental revenue engine. And this fundamental strength is incredibly broad-based across the company. Total net revenue reached $1.21 billion. That's up 14%. Viewers spent a staggering 36.5 billion hours streaming on the platform. Think about how much time that is. Plus, the Roku channel isn't just some side project anymore. It held its spot as the #2 app on the entire platform by US engagement. That makes it a massive, top-tier driver for programmatic video advertising. Now, this fundamental growth, it doesn't just happen by accident. It's fueled by highly targeted interface innovations. Take the NFL Zone, for example. During kickoff week, Roku highlighted this right in their home screen menu, and visits to the zone more than 3 times year over year. By aggregating live sports and making it super frictionless for the user, Roku drives way deeper engagement. That boosts subscription signups for partner services, which, you guessed it, directly feeds their platform revenue. Let's bring it all home with Section 5, the long-term investor perspective. As long-term investors, we should be using a balanced 3-step approach here. First, absolutely acknowledge the mathematical reality of historical seasonality. You need to know that November historically surges and March historically slumps. Second, always verify those trends against the cold, hard fundamentals of the company's financial reporting, just like we did with their Q3 numbers. And third, prioritize long-term cash flow and underlying revenue growth over trying to time a specific calendar month. This crucial point is captured perfectly by Roku's founder and CEO, Anthony Wood. He notes they see a significant opportunity to drive double-digit growth in platform revenue in 2026 and beyond, which ultimately leads to increasing free cash flow per share. That's the real takeaway here. The ultimate goal for a healthy company isn't winning a specific month on a chart. It's about driving long-term, sustainable shareholder value. Which leaves us with a final, provocative question to consider today. When you're looking at a dynamic, highly monetized platform like Roku, do you let the seasonal calendar dictate your moves, or do you follow the underlying fundamentals? The best investors definitely understand both, but they heavily rely on the latter. Thanks so much for joining me on this explainer today, and I really hope this provided you with the clear, structured insights you need to understand Roku's broader market picture.